All right, everybody, welcome back to the Capital Raising Workshop. We are in session 6 of 3 sessions. Yeah, you know, I like to do that a lot. All right, so in this session, we're going to be talking about communicating with potential investors. And this is the last session, I promise. There is a supplement video that you can go watch. I'll explain that shortly. But for live, this is the last live session for the Capital Raising Workshop. Though I think it's been a pretty good workshop. So what do you say we just get started and get the ball rolling here? So what are we going to cover today? Well, you need to have something to offer. You can't just go out and raise capital if you don't have anything to offer. So we'll talk about how to position yourself so that when you have something to offer, you can attract passive investors. And then why you? So we're going to go through about 50 questions. If you've taken the strategic partnering workshop and you have attended the property management section, which is module 11 of the strategic partnering workshop, I went through a 49 question questionnaire on how to hire a management company. We are going to do the same thing for raising capital that will prepare you to be able to answer the questions that the investors ask. Now, the most comprehensive list I have ever seen is in the book, Best Ever Real Estate Investing by Joe Fairless or something like that. Best Ever Syndication book by Joe Fairless. In there, he lists 49 questions. So I have those 49 questions. A couple are edited to be a little better, and I've added 1 or 2 and maybe taken away 1 or 2. So there's about 50 questions in this. Again, that is the most comprehensive list I have ever seen, and it covers just about everything. What we're not going to talk about is property-specific information that you can cover on the offering summary, like, you know, what kind of return am I getting? What's the average cash on cash, things like that. We're not covering those types of questions. These are the types of questions that you start to ask to get them interested in you and what you're doing. Then we'll go into the offering summary itself, and I will go down and show you each section of an offering summary template that I am going to provide you. As a matter of fact, I've already uploaded all 3 templates to the members area. You've got a property-specific template, a market summary, and a blind pool type template. So all 3 templates are there. We're going to go over the property-specific template today and just cover what each section is in the offering summary. And then where it says plus supplement means that there is an additional video. It's already been uploaded. I haven't made it viewable yet, so you can't see it until I get this recording of this up in the members area. And then session 6 will become visible. But everything is already uploaded. It's there. And the supplement will actually show you how to edit and modify the PowerPoint template to make it your own. Now, if you're a Mac user, my apologies. I hate Mac. I will never touch a Mac. And so whatever Mac's version is of a PowerPoint, you're going to somehow have to convert that Microsoft PowerPoint into whatever Mac's version is. My apologies for that, but it is what it is. I don't touch Macs with a 10-foot pole. Deal with it. No, just kidding. Then we'll cover your homework and have our final Q&A session. And if no one else shows up except Corinne, it will be a final one-on-one session. All right, so let's start with having something to offer. But before we talk about having something to offer, you need to understand something. And it drives me insane when I hear people call it a pitch deck. You're not pitching anything. You're not selling anything. You are offering an opportunity. And I want you guys to understand that you need that mindset. Okay. You're not pitching. Pitching is something you do when you're trying to sell a board on your enterprise level software that you're charging $100,000 a year for. That's a pitch. We're not pitching anything. We're offering an opportunity. All right. So I need you to do a mind shift and start thinking that way. That way you will always treat your investors properly, which is really important to me. All right. So having something to offer. Well, it can be strategy specific. So what the heck does that mean? Well, you have different strategies in the multifamily world. There's value add strategies, cash flow strategies, development strategies, all right, ground up development. Value add could be in a growth market or in a down market. You'll start to find value add opportunities where you've got lower occupancy or deferred maintenance. Now, most of the properties through the last expansion got renovated, not all, but most. And so you might not have a deferred maintenance value add opportunity, but maybe there's some opportunity for some operational efficiencies, things like that, that can still be considered value add. A cash flow strategy means that you're purchasing for cash flow. You have a specific cash flow requirement. That is the KPI you're going after. And so when you're raising capital, that's what you are targeting. You're targeting cash flow specific opportunities. And then, of course, there's ground up development, and that does not need a description. Or you can target just conventional apartments. That's market rent. Conventional just means market rent. You have conventional, there's low income, whether it's just Section 8 or low income housing tax credits, Section 42, which is HAP, things like that. Then you have senior living and you have student. Okay. Notice assisted living is not in this section because assisted living really isn't a subset of multifamily. It is, but it isn't. It actually belongs more in the medical office realm than it does in multifamily. But for whatever reason, people like to bundle it up inside multifamily. Now, when I talk about assisted living, I'm talking about memory cares and things like that, where you've got nurses and doctors and staff that are operating a medical facility in a building that houses multiple people, that's where they live and stay. So that's what I mean by senior living. There is this other strategy that they're calling residential assisted living, RAL. Just people try to think up tactics and strategies to do things. This is where you take a house and convert it into more of a, let's see, somebody's got their, no. Neil, mute yourself, boy. All right, I muted him. Residential assisted living is more of like you take a house and you turn it into a boarding facility for seniors, where you might have a nurse come in on a daily basis and take care of people. That's different than what I refer to as assisted living, which is not in this section. So just wanted to tell you why assisted living wasn't here. You could also put mobile home parks here, but I didn't do that. So those are strategy specific opportunities where you are letting investors know, I don't have a property yet, but this is what we're targeting. And if this is something that interests you, then we'd love to get your contact information, maybe have you fill a couple of things out. And when we have an opportunity, we'd like to be able to send that to you to see if you're interested or not. All right. So that's strategy specific. Oops. Market specific would be targeting a market like an MSA, which is a metro statistical area, a region, a local market. So you may live in the Orlando metro statistical area, but you are only targeting Seminole County, which is the affluent county in the Orlando metro statistical area. You're just targeting Seminole County. And so that would be local market specific. And just like with strategy specific, here you're just letting investors know, and you can combine the two of these, that I'm looking for value add conventional apartments in Seminole County. And if you're interested, we'd love to be able to send you something. Would that interest you? And then, have that conversation about how much they'd like to invest, things like that. Okay. So that is strategy specific and market specific. Woo, saying specific a lot can be a big tongue twister. Then we get into property specific. And this is what most people do. Now, if you're waiting until you have a property in your hand under contract to build relationships with investors, you've missed the boat. It's too late. Okay, that's why you need to know what your strategy is going to be, what markets you're going to invest in. That way, you've built that database up of potential investors. So when you have a property, now you can send them the information about that specific asset. Do not do what the stupid gurus tell you to do. And, oh, it's okay, go find a deal. If it's a good opportunity, the money will follow. Bullshit. Doesn't work that way. You've got to have the relationships first, or have the relationships that have the relationships, bloody, bloody, bloody. All right. The best thing to do is have those relationships in your database. So that's why strategy and market is so important. So that when you find that property, you have an opportunity that you can send them. Does that make sense to everybody?
Yes, it does. Thanks.
Well, thank you, Rebecca.
Yep.
All right. So that's something to offer. Well, once we know what we have to offer, now we have to position ourselves to make ourselves attractive to investors wanting to invest with us. So first is the team. People do not invest with individuals. And it's the old adage, what happens if you die? And you'll notice when we get into the questioning later that question isn't there, because it's answered everywhere else. There's no reason to even ask that question, because you will have already answered it before you even get to that point. And that is by presenting your team. So if you don't have a team, you need to start building a team. So this could be partners, strategic partners, operating partners. So by building relationships with property management companies, they can become your operating partner, right? A lot of them, and I've mentioned this in the strategic partnering workshop, when you're interviewing a management company, one of the questions is, do you invest in deals that you manage? And if the answer is yes, that is possibly a property management company that you want to build a relationship with to work towards becoming an operating partner with you, especially if they're going to invest in these deals with you. What they typically like to do is they like to put in 10% of the equity, and they'll tell you, for that, we want the ability to operate the property, to be that management company. So they're investing, and because they're investing, they're invested, which means they will do a much better job. They have skin in the game now, so there's a reason for them to do a great job. You can still fire them if they don't do the right thing. And of course, you want to have contracts in place that allow that to happen. But that's all in the property management module. I just want to show how important it is to have an operating partner as a team member. Experience. Okay. So this could be you or your team, but there's going to have to be experience. Nobody is going to invest with someone that has never done a deal before. So if you're just getting started and you know what your strategy is, and you know what markets you want to do, but you don't have a property yet, and you're out trying to build relationships with passive investors, you've got to have somebody on your team that has experience. So here's where you want to partner up with someone else. That is why I started the strategic partnering community, because it's so important to have these types of relationships where you guys can work together. All right. So if you don't have experience, somebody else might, but maybe you're bringing the relationships to the table. It makes a good partnership. Now, you still got to know, like, and trust each other as partners. It isn't one of those like the gurus do where they say, hey, come into my $35,000 program and I guarantee we'll get you into a GP. It doesn't work that way, because you might be oil and water with that GP team. That does not meld for a good situation in any way, shape, or form. You got to be able to build those relationships organically. Okay. So experience, you got to have it. Either you have it or someone on your team has it. Don't be afraid to leverage both. And as you're building the relationships with those team members, ask them, is it okay if I let the people I'm speaking to know that I am part of your team? Okay. And they shouldn't have a problem with that. And then there's outside relationships. So you've got to position yourself with lenders, brokers, management companies, attorneys, and CPAs, the legal and financial. All right. Because as you're going through and having conversations with passive investors, they're going to ask, who do you use for lending? What types of loans do you typically go after? What are the terms? What are the interest rates? They're not stupid. They wouldn't be investing if they were stupid. Do you use brokers? Who are your brokers' relationships? Do you have an operating partner, that management company? Of course, we could have answered that with team if you have a management company as an operating partner. Who do you use for the private placement memorandum and all of our disclosures? Or how do I know that I'm going to get my K-1s on time so that I can file my taxes on time? So that's where financial comes in for the CPA. So you want to have these outside relationships. So when you're having these conversations with passive investors, you have the answers. Does everybody understand why you have to have all of this? The
Yes,
last
it
one.
gives you credibility.
Yeah. Well, it's, if you cannot answer these questions, you've lost them. They're not going to be there for you when you have that opportunity. All right. So we're just positioning ourselves, getting ourselves in that position so that when we do have that opportunity, it becomes a nice, smooth process. And then you have to have the capacity to execute. Again, you or your team has to have that capacity to execute. Have you closed on any deals? Have you gone full cycle? Have you been through a full market cycle? How many syndicators that you guys have witnessed over the last however long you've been in this business? How many syndicators that are currently doing syndicate? And I'm not talking institutions. I'm talking in the Sun Belt, the syndicators, some in the Rust Belt, in the Midwest, where they are fairly new and are raising capital for deals and have gone on some guru group. To include the gurus, how many do you believe have gone through a full market cycle, meaning they were in the Great Recession, or they were doing deals, doing multifamily deals, syndicating deals prior to the Great Recession? Very few. I'd say less than 1%, including the gurus. I know Lindahl's been through it, and I don't know if Rod Cleef has been through it as a multifamily investor. I know he was as a single family investor, but I don't know if he was as multifamily or not. And although Sumrock will tell you that he's been in business since 2005, he was doing single family up until about 2012, 2013, when he finally got into multifamily. So he has not done multifamily through a recession, no matter what he tells you. Okay. So finding people that have been through a full market cycle are going to be very, very rare. But guess what we have coming? We are coming to the end of this market cycle. And on the back side of this, if you can survive through the recession that's coming and continue to march on the other side, you will have been through a full market cycle, right? You won't get that question a lot, but it may come up, especially as we're entering this market cycle. And you'll see when we get into questioning, they may actually ask, how are you positioning yourself to be able to handle the coming recession? And as long as you can answer that, you'll be good to go. All right. Does that make sense? So why you? So these are the questions. And for those that just jumped on or didn't hear me say it before, 95% of these questions came out of the book, Best Ever Syndication Book by Joe Fairless. It's the most comprehensive list I've ever seen put together. I went through that list with a fine-tooth comb, and he's absolutely right with all of it. And I took a couple away and I added a couple. So that's how comprehensive it was. So we got about 50 questions. I didn't actually count them. It's somewhere, it's 50 plus or minus 1 or 2 questions. All right. So that's what we're going to go through now. So why you? So first thing that you want to do when you're having a conversation with a passive investor is you want to start by asking them about their background. Okay. Well, you want to know, how busy are they? All right. The reason we want to know that is because it qualifies them as to whether they are passive investors or not. The busier they are, the more qualified they will be to want to invest in multifamily deals, especially if they've never invested in a multifamily deal before. So we want to ask about their background so that we can find out how busy they are. You can also determine a little bit about their personal aspects, how they've been investing before, things like that, and be able to let them know, and you're going to see later on in the questions, how you can position multifamily to be a better investment for them. Ask about their investing and personal goals. Again, we are still qualifying them. They're qualifying us, but at the same time, we have to qualify them. Now, you can expect, as you're asking these questions, they're going to have questions of their own. So you need to be ready to answer those questions. And the 49 question investors ask, which came out of the Best Ever Syndication book. And again, it's about 50 plus or minus 1 or 2 questions because I've done some editing in this. Okay. So question number 1, and I'm not going to go number 1, number 2, just as we go through these questions. How much money do you have in the deal? So if you're not, or your team is not investing in the deal yourself, you may be positioning yourself in a position of weakness. So you want to let them know that either yes or no, you're putting money in the deal. One of the best ways to do that, especially in an expansion market, when the only way to get into a deal is to put hard money up day one. Don't get me started on that one, but there is a way to protect yourself if you do that. Let them know, look, we didn't want you to put up any at-risk capital, so we've put up all the at-risk capital already. And so hopefully that'll make you feel a little more comfortable. So that could answer that question. How many of your investors have invested in multifamily deals? Okay, so here, investors that you've had in the past, not multifamily, multiple deals, investors you've had in the past, how many times have they invested with you? Do you have repeat investors? Again, we're looking for experience here. So this is why it's important to have a team if this is the first time you're getting started. That way you can give your team's performance, not necessarily your own. And don't be afraid to do that. That is perfectly acceptable. Do you have family and or friends that invest in these opportunities? Okay. If you're offering this to family and friends, it means you truly believe in this opportunity. Otherwise, you're just the biggest jerk on the planet. So it makes them feel a little more comfortable if you do have family or friends investing in these. Now, if it's a 506C and they ask this question, so if it's a property specific and you get this question for a 506C, which is accredited only, and you don't have family or friends that are investing, you can just tell them, no, I don't, but it's because this is a C and none of my family or friends are accredited investors. So they aren't investing in this. Although that could give an indication of who you hang around with. If your friends aren't accredited, that could be a little bit of a ding against you. So be careful saying something like that. Does that make sense? Do you guys understand what I mean by that?
Yes.
Yes. David, can I interject with a question?
Sure.
Is it not correct, or as a LP investor, can you ask to see the general partner's bank statement showing that they actually put money in the deal?
Yeah.
You can. Okay.
Why not? And if they don't show you, what are they hiding?
Yeah, that's what I had. One not want to show me, told me I wasn't the right kind of investor for that deal. So I didn't know if I was
No, then say,
stepping on
okay,
their toes or not supposed to.
No. So look, you guys got to remember that 90% of the people out there doing deals right now in the syndication world, they're taught by gurus. They're followers. They're not students. So whatever the guru tells them is gold. What does that mean? That means that they've been told that the lower amount that someone invests, the more pain in the ass that person's going to be. So if you're asking questions like that already, then they're probably already targeting you as a pain in the ass investor so that you're not a fit for their deal. Today, people are struggling to raise capital. If they're still having that mindset or they're using that excuse, then I'd say they are absolutely hiding something or they're lying, because everybody's doing everything they can right now because of the market cycle we're in order to get capital into their deals. So you have the authority to ask anything you want. It's your money. You're investing with them. If you're doing this as a passive investor, you are qualifying the sponsor. The sponsor is qualifying you. You are qualifying the sponsor. So just like the sponsor asked you about some of your personal information so that they can gauge your level of qualification, they have the right to ask questions like that to gauge your ability to do the right thing. So don't ever think that that's not allowed, because that's complete BS. All right.
Understood. Thanks.
Yeah. Sorry, I get really on my soapbox when I hear stuff like that, because it just shows the greed that has come into this marketplace over the last 5 years. And it's the reason syndication is going to fundamentally change at the end of this cycle. The SEC, the Dodd-Frank Act allowed the syndication world to explode like it did. It's going to be repealed. No question. I think it's even going to go even stricter than prior to the Dodd-Frank Act. That's just my opinion. But I know for a fact, and I don't think there's anybody that doesn't believe that the Dodd-Frank Act will be repealed. Maybe not fully, but a lot of it will be reversed, primarily dealing with syndication. How many investors do you have in a typical deal? So now they just want to know, for deal sizes that you're going after, how many investors are there? Here, they're not necessarily wanting to see the most. They want to see how watered down their investment's going to be, because they want the most return for their money. All right. So where you see these syndicators going after 300, 400, 500 unit apartment complexes, and they need 50, 60, 80, 90 investors, that investor's rate of return gets watered down with that many investors in the deal. The fewer investors, the lower the price point, because you can have fewer investors for lower price points. the more return that they can get if you're buying the property correctly. Does that make sense? What is your experience? Now, again, if you have no experience, tell them. I personally have not done a deal yet, but my team, and then go into your team's experience. Don't try to hide the fact you don't have experience. They're going to love your transparency and your honesty. Just tell them, I personally don't have the experience. I'm new to this team, and this team has done da 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 da. It's just as strong, maybe even stronger than trying to BS them with your team's experience and trying to make it your own. How long have you been doing this? Again, if you're brand new, say I'm new to this team that's been doing it for da 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 da. There are multiple syndication groups I can choose. Why should I invest with you or your company? Okay, that one. Now you need your value proposition. Okay, what positions you better than everybody else? By the way you're answering the questions and being open and being transparent and being honest, they're already going to see that you're different than everybody else. And you're going to get a lot of credibility from doing those types of things. Okay, so don't be afraid to answer questions like this. If you have a mission or a vision statement for your company, then this may be a good time to let them know what that is. And the other thing is, and I don't know if anybody else is doing it, but you hear me say it all the time. If you can show in your core values that protecting residents and investors is one of your number one core values, you're going to get a whole lot of credibility with them. Okay. Make them understand that you understand your fiduciary responsibility to them. I guarantee you nobody else is doing that. How do you know your business partners? How'd you meet? How'd you find your team? That one goes pretty much without saying, needs no further explanation. Where D, typo, where did your business partners work before? Okay, so if they've been together for 5 years, what'd they do prior to that? Do not be afraid to answer this question. If you don't know the answer to this question for your first investor, the first time you get it, just let them know, I never really talked to them and asked them about that, but let me go find out, and I'll send you a separate email or a text, and I'll let you know what the answer to this is. And then you go find out so you never get caught in that position again. Now, you've seen this question already, so now you know to ask this question beforehand. What they're looking for here is they just want to make sure that it's not just a business relationship, that there's some personal connection. And by asking a question like this, then they know if you can answer this question that you have a personal connection with your partners because you know what they did prior to building this real estate company. Have you ever taken a deal full cycle? Okay, again, if you haven't, and your company that your team members have, just say, no, I haven't, but my team, da 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 da. Or if you have, just let them know you have. They may follow that up with, what were the returns that you got from it, and just explain to them what those returns were. Is the investment in a fund or in an individual property? If you're building a fund, tell them it's in a fund. If you're doing this for an individual property, then let them know that I don't have a property yet. If you're just having this conversation with them and you're trying to build relationships prior to finding that opportunity, just tell them it's going to be for an individual property that we don't have yet. If you remember, for our specific strategy in our specific market. Do you currently have any deals under contract? Well, if you just answered the question, no, it's not for a property today, but it is for in the future, the answer here would be no. Or if you do have one under contract and this is for a specific property, then they may ask this question instead of the question above it. How do taxes work in this investment? Now, I'm going to highly recommend that all of you learn how tax is used in an investment property. And that does not mean some guru. Rebecca, she's covered. David, he's covered. Neil probably needs an investment course from an institution. Corinne, I don't know, what institutional level education you've received, but nobody in the guru groups teaches after-tax strategy. And I'm considering teaching after-tax strategy as I update the strategic partnering workshop, which is no longer going to be called the strategic partnering workshop, but that's going to be announced in the next week or so. If you do not understand how cost seg works, how bonus depreciation works, how capital gains works, how 1031 works, how depreciation recapture works, then don't answer that question. Just let them know that you have a CPA and that your CPA handles all of the after-tax strategies. That if they have a specific question about a specific tax strategy, you'd be more than happy to get with your CPA and get that question answered for them. In the financial world, we teach after tax. I say we because I teach for the CCIM Institute, and the CCIM Institute has the curriculum for 135 MBA real estate programs in the country. That's institutional level education. Without that education, you're not going to understand this. They will tell you, your gurus tell you, and I'm sorry I'm going off on a little tangent here, but it drives me nuts when I hear everybody touting that we're doing this deal because of bonus depreciation. Well, guess what? You're only holding the property for 2 or 3 years, which means you're going to pay more in tax using bonus depreciation than if you'd just taken capital gain. But because they don't understand after tax, they don't realize that until they get their K1s. Okay, so don't do that. Actually learn and understand after-tax strategy to answer a question like this, all right? Do not take what you've learned from a guru. Make sure you understand the strategies. Hopefully I've pounded that in enough. What type of financing do you typically do? Okay, if your team, you or your team typically goes after agency, let them know what the terms you go after are, your loan to value, your debt service coverage ratio, all those different things. If you're doing bridge, let me slap you in the face now, but if you're doing bridge, let them know the type of bridge deals you get. It would be beneficial if you're doing bridge to let them know you understand the pitfalls of using bridge and understand the market cycle we're in right now and how you're protecting yourself, knowing interest rates are still climbing and that inflation is still not under control and that operating expenses are increasing faster than rents are increasing. As a matter of fact, in most markets, rents are declining. So knowing all those, you understand how to protect yourself using bridge. So don't just tell them agency financing and move on. Give them background, give them details. Does that make sense to everybody? You understand that? It shows your knowledge. It displays, even if you don't have experience, that you definitely are learning from other people with experience. And it shows that you're willing to protect them because of the market situation we're in. How frequently do I get paid? Is it monthly? Is it quarterly? If you're doing a value add strategy, does it not start a year from now? Let them know, even if you don't have a deal yet, you're just having this first conversation with them. If they ask this question, understand through your strategy when they will start getting paid, how often they will get paid, and then just let them know that, it could be a range. Say we do preferred returns between 6 and 8 or 10%, depending on the deal, depending on the market, depending on the asset class, everything else. That will answer those questions when we get that property under contract. Can you walk me through the typical investment from an investor's point of view? If you've never done if you've never gone through the process of offering an opportunity to investors before, it's going to be hard to answer this question. This will be one of those where, again, transparency is going to work for you, where you say, I personally have not gone through this, so I don't have the answer to this question right now. But if this question is important to you, is it okay if we have another meeting with whoever one of the team members is that can answer this question? And they'll be able to answer and confirm all the questions that you have relied on your team about, and you'll gain credibility with your passive investor by doing this. What are the major risk factors in investing in apartments? Here, that should be an easy one for you to answer because we've all been taught what all the risks are. Now, right now, risks obviously are skyrocketing insurance, the market declining, demand declining, oversupply, which is happening freaking everywhere, affordability being shot way beyond the target affordability process. I think I said interest rates climbing already. Property taxes out of control in states like Texas. I just got my property tax notice for my personal home this week. My tax actually went down $50. Shocking, isn't it? Questions or risk factors like that. And if you can answer that question fluently and with conviction, then they'll know, okay, they understand the risks. That means they can protect me if something happens. Can you provide me with a worst case scenario for a typical investment from an investor's point of view? This shouldn't be hard to answer. Worst case scenario is we purchase a property. We are in an expansion market. We purchase the property with 3-year interest-only bridge debt that is a variable rate, and we don't buy a rate cap, and interest rates start to skyrocket, and we did not anticipate that happening. And then in 3 years, we're not able to sell, refi, or get a loan workout, and we end up going into foreclosure and you lose your investment. That is a worst case scenario. And then you have to follow that up with how you're protecting yourself that will not happen. Okay. I'd actually recommend transcribing what I just said and use that specific worst case scenario, because you're about to see that happen over the next 24 months. I'm going to say dozens to hundreds of times. Why should I invest in apartments? Now, I actually wanted to answer this one, so I put the answer up. I'm going to put it up here in a second. Because when I was testing using LinkedIn and Linked Helper specifically for raising capital, I put together a value proposition. And within that value proposition, I probably put together the best paragraph I have ever put together. And so I wanted to put that up here, because if you use this, you'll blow your investors' minds that this is even possible. They're an investment vehicle that gives you a monthly or quarterly dividend, a tax shelter, low volatility, is recession resistant. It's not recession proof. It's recession resistant if you buy right. and produces higher returns than the stock market by investing in tangible assets that grow in value through forced depreciation. Okay. The caveat, you got to buy right, or that does not happen. But that's the best set of words I've ever put in one paragraph about multifamily investment. So I wanted to put that in here so you guys have a copy of that. Why did you decide to pursue this type of investment model? Now, that's going to be different for everybody. You just have to answer this question for yourself, or why you joined the team you joined, because it aligns with your pursuit of this type of investment model. How long do I have to keep my money in the deal? Now, I don't know. I almost didn't put this one in here because this is almost a common sense question. Investors know that you really can't pull your money out, that it's an illiquid type of investment. It's not like the stock market. What they're fishing for here is what's your average length of time you want to do deals. I want to use this opportunity to let you guys know that if you're doing cost segregation, which the gurus tell you you must do, then your investment length needs to be between 5 to 7 years minimum, or you're not going to get the benefit of spending the money for the cost seg, and you will have lost money getting the cost segregation done because you do not get the full benefit, the full tax benefit of cost seg, which is why bonus depreciation does not work for a flip. And that's what everybody's been doing, 2 to 3 year flips using bonus depreciation. Doesn't work. Okay, you pay more in tax doing that than if you took capital gain. All right. So also, and they may already know this, especially if they're accredited investors, that the internal rate of return peaks between year 6 and year 8. And so that's why you see a lot of 7-year investments in the institutional world, because they're investing at the peak of the internal rate of return, where they get the most return out of that investment. All right. And if they are an IRR or a yield type investor, they want to see it between 6 and 8 years, or between 5 and 7 years. Closer to 7 you get, the better off you can be, because you will have got the maximum value out of that investment. Okay. If you take a institutional level academia financial class, you'll understand this a lot more. May I please take this opportunity to recommend CI 101 with the CCIM Institute. Okay. If you're not a CCIM member or a realtor, it will cost you $1,750, but it'll be the best damn $1,750 you ever spent. I'll just leave it at that. What happens if I want to use my invested money for something else? Can I pull it out? In your operating agreement for the LLC will have ways they can pull it out. They're not easy. Okay, it should be in the operating agreement if that sponsor is doing the right thing. They may require the investor to find a replacement first. There may be a first right of refusal for the sponsors themselves, but that money has to be replaced somehow, some way. You can't just pull the money out. Okay, it doesn't work that way. So you just have to explain that to them, that in the operating agreement, in the disclosures, there will be a clause on how you can pull your money out. And if you've received a copy of a previous operating agreement, if you're new to the group, then you'll be able to explain in more detail what your group does in this situation. How are you finding deals? Okay, just talk about your acquisition strategy. All right. Especially if you are utilizing Acquisition Pro and you're looking for off-market opportunities, which will give you the best opportunity to get the investor the largest return. Ooh, that's powerful. What markets are you currently focused in? Now, this question should have been answered when you talked about your strategy and the markets that you're investing in. If that hasn't been covered yet, you will need to cover it here. Do I have to submit my financials to anyone? Now, If the easy answer to this is no, unless it is a 506C. And then the only reason they have to submit is to prove whether they're accredited or not. Okay. You're not submitting to a lender. The lenders do not make passive investors responsible for the loan unless they have greater than a 20% stake. They call out the 20% rule. You never want a passive investor to have more than 20% in a deal, or they have to be written into the loan. Every lender requires that. If you have a 20% stake in the deal, you are required to be on the loan. Okay, so you got to be careful with that. Otherwise, the simple answer is no. We do not use the passive investors as a guarantee on the loan. And you can even tell them unless you have more than 20%, which we don't allow anyway. And let them know that if they're an accredited investor and we're doing a 506C, which requires you to audit and makes you as the sponsor responsible for them being accredited or not, then you need to see their financials in order to make that determination. But in a 506B, even if they're accredited, you allow self-disclosure. They do not have to submit financials in that situation. Who owns the property? Here you get the opportunity to explain to them that an LLC, an entity, is purchasing the property and that they are investing into that entity. That means they do not own the property. Okay, the LLC owns the property. They're investing in the LLC. All right, do you guys understand that? I need yes or no here. I want to make sure you understand that.
Yes.
Yes.
Okay. Neil, you understand that? Neil's not paying attention to us. All right, moving on. Who manages the property? Is it third party or is it self-managed? Okay, if this is a syndicated deal, it means it's a little bit larger if you're raising capital for it. So do you have an internal management company? Do you have that operating partner that is part of the team? Or are you hiring out because it's the first time you're entering the market? You or your team is entering this market. So you're interviewing property management companies. All right, you need to be able to answer this. If you tell them that it is self-managed and you're not a property management company, you're going to have a hard time finding investors. They do not want you self-managing these deals. That's not what you're best in the world at. They want the people that are the best in the world managing these assets. What happens if the project fails? Ooh, good question. Okay, so we're going to see a lot of those coming up. Here you get the opportunity to tell them you're going to do everything in your power to ensure that you get out of the deal before it fails, that you see it coming, the market is changing, interest rates have skyrocketed, whatever the case is, you see it coming and you have a plan to get out of this deal so that it does not go to foreclosure. Foreclosure is the worst. That at worst case scenario, in your eyes, even though it's not worst case scenario, they'll at least get their capital back. So if it fails, the goal is to sell the property for what you paid for it so you get your capital back. You may not get a return, but we're going to try to get that capital back or as close to it as possible without going through foreclosure. And you just have to explain that to them. Let them know that you understand there is a potential there for failure. How do you plan to tackle that? I guarantee you 90% of the syndication companies, they're telling them it's not going to fail. Don't worry, we're good. And if it does, we'll make sure you get your money back. That's all they're telling them. They have no idea how they're going to do it. Okay? Don't be them. What types of reserves are typically established to protect investors from any potential capital pitfalls? Well, here you just explain to them what your capital reserve plan is. You should always have some kind of loan reserves in there so that you can at least pay the debt down if the NOI drops below the debt service coverage ratio, which means it's negative cash flow. So you have to have reserves to be able to continue to pay that loan so that you're not asking your investors for more money. What they're saying here is, do you have reserves so we don't need a capital call later? They're just not saying that. What happens if the investment needs more money? Now, you did not put those reserves in, or you went through your reserves because you're doing so bad. Now you need more money. What's the process for us to do that? So now this is going to be spelled out in the operating agreement and in the private placement memorandum. So here you get the opportunity to explain to them how a capital call works and how it will work for this investment. And that if they don't invest, what are the pitfalls for them not investing on a capital call? What are my responsibilities? That's the investor asking, what are their responsibilities? Invest, sit back, watch, learn, enjoy. That's it. They don't have voting rights. They don't have management decisions. There's really nothing that they do unless you screw up and need a capital call. Then they have a responsibility to protect the investment and bring more capital to the deal. What are your responsibilities? Now, this could be a very long list. So you can let them know what your specific responsibilities are on your team, and then let them know who else is on the team and what their responsibilities are. The more detailed you can be, the more comfortable you're going to make your investor feel. How much of a role do you personally take in overseeing the acquisition and management of the properties? Again, you just have to answer this as part of your role in the opportunity. Be as detailed as possible. Don't hide anything. Be transparent. The more transparent and the more honest you are, the better chance you have of getting to those commitments. Do you guarantee a return? What do you guys think? Do we guarantee a return?
No.
Never, ever do we guarantee a return. What happens if you can't make the projected cash flow? Okay, here's that capital call situation. This falls in line with a couple of the other questions. What does my money go towards? Ooh, good question. And the amount of syndicators that do not give the full answer to this, let them know and be honest and transparent. It's going towards the acquisition fee. It's going towards capital improvements. It's going towards the acquisition of the property. It's going towards reserves for the loan. It's going towards reserves for capital improvements. Okay. It's going towards closing costs. It's going to pay the sponsor back for the earnest money, if that's true. Now, when they asked you earlier, did you put skin in the game, or what are you putting in the deal? If you told them you put the at-risk capital up, and now you're telling them you're going to get that money paid back by the investors, now you have no money in the deal. You think you did the right thing? Probably not. Okay, you want to keep some money in the deal. But if that is the case and you are being repaid for the earnest money, you need to let them know that. And it should be in the private placement memorandum anyway. If it's not, you're hiding things. That's negligence, potentially even fraud. So don't hide. Disclose, 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 disclose everything. Be as transparent as possible. Okay? That will make you different than everybody else. God forbid. How do you make money? Tell them how you make money. Acquisition fee, asset management fee, refi fee, project management fee. If you're a developer, development fee. What are the fees that you're going to earn? How do you make money? And then you can take this opportunity to explain the waterfall structure, that if we reach a certain hurdle of 15% internal rate of return, then it's no longer a 70-30 split. Now it's a 50-50 split. So we make a little bit more money on the backside with internal rate of return. And then from the proceeds of sale, my percentage in the deal, I can make money from that. Okay, those are the ways you can make money. Be transparent and honest about all of it. What is the minimum investment? That's an easy answer, and that will be in accordance with your team and your investing guidelines. Now, again, the gurus will tell you the lower they invest, the bigger pain in the ass they're going to be. Okay. In some cases, I should say in rare cases, that is true. But I've known people that have invested $150,000 and were a big pain in the ass. Okay. So where you have your 10% on the low end, you've got your 10% on the high end. It's that 80-20 rule any way you look at it. All right. So I would not worry about this. If you're raising capital for something and you're $18,000 short and you have a $50,000 minimum investment, let somebody come in for $18,000. It's not black and white. Just because you have a $50,000 minimum investment doesn't mean somebody else can't invest for 35, for 25, for 20. I wouldn't do a Grant Cardone and let him come in for $1,000. Don't do that. You'll end up in his position, on his way to jail. But if I'd come down, I think the minimum we took when I was raising capital and doing syndications, I think the minimum we ever took was 15. And I think it was only one that did 15. We did plenty between 20 and 30, and we've had investors at 50 and we've had investors at 100. I haven't had any investors higher than 100. I did have one that said they would invest over up to $1 million in the right situation. We never ended up using that investor. So this, again, determines what your strategy is. And don't follow guru frickin' talk. That's all I ask. How does the process work after you find an investment? So go through your process for letting the investors know of the opportunity, that there will be a presentation on the opportunity, that they'll receive an investor questionnaire if they have not filled one out already. Then if they decide they want to invest, they will receive a subscription agreement with bank transfer account information to transfer the money into the bank account. And then if you have an investor portal, you can give them access to that investor portal where most of those documents are held, stored, and everything else. Just let them know what that process is for you or your team. What are you doing about the market correction that's coming? I think we've covered that pretty good through this on protecting yourself for the rising interest, the rising insurance, the operating, which is part of insurance, is part of operating expenses growing faster than operating income. How are you protecting yourself from that? And as the recession occurs and demand shrinks with all the units still being delivered to the market, what is your plan? So that's why I tell everybody, and this is where David Lindahl's strategy, which he was one of the first gurus I was ever introduced to back in 2011? I read his book, Multifamily Millions. He has a strategy in there called the Holy Trinity. And in the Holy Trinity, one of the requirements is that the deal can support day one a 1.6 debt service coverage ratio. This is a time, as we enter this recession, that 1.6 ought to be gospel. That will protect you. That gives you the ability to reduce your NOI by 40% before you hit the lender minimum, unless the lender minimum is 1.25 or 1.3. If it's 1.2, it gives you 40%. If it's 1.25, it gives you 35%. If it's 1.3, it gives you 30%. But it gives you room for your NOI to go down as you work your way through the recession, and will protect you through the recession. That's why I said when multifamily is recession resistant, you have to buy right. It's recession resistant because people always need a place to live. Companies don't always need a place to conduct business, especially now that most people work from, or a lot of people work from home. They can let a retail space go. They can let office space go. That's not life. That's not a life needing thing. Having a roof over your head is a life needing thing. That's why multifamily is recession resistant, but you have to buy right. How do you buy right in a recession? Make sure you have enough cushion for your NOI to drop during that recessionary phase. That is what you're doing about the market correction that is coming. I hope that helps. What contingency plan is there for the properties if we go into a recession? Right? So you have to talk to your team and determine what is our contingency plan if we did not buy right. We need to start selling now. What are we going to do to protect our investors? Should always be about what are we doing to protect our investors. The key here is if you buy right, you shouldn't have to worry about it. You've already put that contingency plan in place by purchasing at a 1.6 debt service coverage ratio. You can thank David Lindahl for that, not David Monroe. Are there any other asset classes you focus on? Hopefully you say no. Because if you don't focus, then why would they invest with you? Now, when you had the conversation with them in the very early stages where you asked them about their background and about their financial and personal goals, if one of those was diversification, maybe you can get away with here saying that you also invest in storage units or mobile home parks or conventional and low income or conventional and senior or low income and senior. Okay. You have the opportunity to do that. If they did not answer that question that way, you want to be focused and just say you are focused specifically on this asset class with this strategy in these markets or this specific market if it's only one. Okay, that won't hurt you. That will probably help you. Is everyone notified at the same time when you have a new opportunity? They're trying to see here if they can gain some status and potentially get first dibs on an opportunity. Depending on how the conversation is going is how you answer this. If you feel like this is an investor that can invest up to $1 million, give them special privileges. But if they're just another $50,000 investor, let them know, yes, everybody gets notified at the same time. You have to feel that out as you're having that conversation with that person. If it's someone that has invested with you multiple times or has invested with the team multiple times and is just being introduced to you, you're probably going to want to find out from the team whether we give this person special privileges or not. Who will be my point person? Is it going to be you? Is it going to be somebody else who's doing investor relations or asset management? Who's that point person going to be? Or is it the CPA for the group? Can I invest with an LLC? I don't know. Can they? You guys tell me. Can they invest with an LLC? Let me wake you up a minute. We're almost to the end of the questions.
Yeah, I believe so.
Anybody else have an opinion on that? Or factual information? Corinne's the only, was that Corinne or was that Rebecca? I think that was Rebecca.
That was Rebecca.
Yeah. Rebecca's the only brave one, huh? Yes, you can invest with an LLC. Absolutely. Preferably, actually. Okay. Because even with taxes, LLCs are flow through entities. Okay. What you don't ever want to do is invest in an opportunity with a corporation because you'll get double taxed. Because not only will your corporation get taxed, but you will also get taxed. So you get double taxed with corporations. So you just want to have an LLC. Yes, absolutely. What type of reporting do your investors receive? So here's your opportunity to talk about asset management, how your team or you does your asset management responsibilities and your communication plan when it comes to asset management, how often they're notified, what types of information they will receive on that notification. And it may have follow-up questions like, will we get to see the financials? Will you show us rent rolls? Things like that. If they ask for it on a case-by-case basis, let them see it. Don't hide anything. Let them see it. The more transparent you are and the better you do, the more they will do more and more investments with you and probably invest more with you. They may invest the minimum the first time because they're just getting a feel for you. But for all you know, they may be that $1 million investor and they're just looking for that sponsor that they can trust that they can invest $1 million with. Okay. But you don't know that until you go through this process. What other questions do you typically get from investors? If you've had some conversations with a few investors and they have not asked some of the other questions that you may have run into, then you can just let them know, well, there's this, there's this, there's this. This list you're seeing now is pretty damn comprehensive. It'll be hard pressed to find a question that was asked that isn't included in this, except for, again, KPI type questions like what's the typical return? What's my internal rate of return that I can get? You know, what's the average cash on cash? Things like that. So this gets answered based on the questions that have been asked so far and what your question bank really is. If you've studied what we've gone through here, because you guys are going to get the slides, I would recommend creating yourself a little checklist with this and having the answer to each and every one of these questions. If I want to talk to other investors, like a reference, is that something you can arrange? If you tell them no, their history, they're gone, you've lost them. If you don't have other investors, probably going to lose them. Again, you want to have an experienced team. So just let them know, yes, that you'll give them a list of 3 investors that have invested with you in the past. If I want to invest, what would be my next steps? Ooh, that is a buy question. That's what we call that in sales. You stop everything you're doing at this point. If you get this question right here, you tell them they need to fill out an investor questionnaire so that you can determine whether they're accredited or non-accredited. And if you have an investment already in the pipeline, you will send them a subscription agreement for that investment. And this is also the opportunity for you to say, how much were you thinking of investing? Okay. So you get this question, stop everything you're doing. This is, I'm ready to invest with you when you get this one. All right. That may not be their intention, but that's what this question points to. So it may trigger further questions later, but if you get this, stop and just assume at this point they're investing with you. They're ready for a soft commitment. Move them towards it. Do you have any tips you can pass on to me as someone who is investing for the first time? This is where you start talking about transparency, honesty. I personally, if I was doing this and I was raising capital and I got this question, I would make them understand the pitfalls of bonus depreciation, and I would make them understand that the average annual return does not exist in the financial world and is a tool that gets investors more comfortable with the deal. And I'd let them know that, and I'd be transparent about that. Woo, doggy, did you just score some points? So use these questions to be prepared. That's all of them. And If you go through each and every one of these and sit down with your team and get every single question answered and have those lists in front of you when you're having a conversation with a passive investor, you're going to do just fine. Okay? Answer these questions before they're asked. So your ability here is through follow-up emails before having that initial conversation with them. Your website, if you have a website, other marketing materials, education that you're putting out there on YouTube, on Facebook, Instagram, TikTok, LinkedIn, wherever you're putting yourself out there in the marketplace, answer all these questions before they're ever asked. You could do it through videos, posts, blogs, articles, podcasts, and your offering summary, which is a great segue to the offering summary. So prior to me talking about the offering summary, crap, that took an hour and 20 minutes to go through that. Do you guys have any questions about anything we've covered so far?
No, that was great. Very thorough.
Mhm.
Okay. Chat, Neil doesn't have anything in the chat. So let's talk about the offering summary. So now I'm going to pop out of here and we're going to go through. Oh, I've got it in the wrong place. Let's grab this and bring it over here. So this is the offering summary template for specific assets. You'll see there's a 220 unit multifamily property located in the Huntsville MSA. So this is for a specific group. Now, this is very ugly. I don't recommend this type of background. So again, there is a video that will be accompanied with this recording that will show you how to edit and modify this template. This is what you're looking at right now is the exact template you're going to receive for specific. There's also one for blind and there's also one for the market. Okay, so you can modify those for your brand, which includes colors, your logo, everything else. Okay, maybe using some property images instead of some crazy background like you see here. All right. So what is included in the offering summary? That's kind of what I want to go through. First thing is you got to have your disclaimer. Okay. You got to let them know that past performance never predicts future, or past success never predicts future performance. And that this is just a general solicitation or offering, all the things that your attorney requires you to have in the document. So if you've got the private placement memorandum started, get the disclaimer from your attorney and make sure that disclaimer is here. You want to have that first and foremost. Here are the table of contents. So you have the summary itself, the highlights, the property, the market, the plan, the financials, and then the team. So these are the sections that you're going to cover in the summary. And you can take this summary and you can send it to individual investors. What a lot of people do is they'll do a webinar based on this. I wouldn't call it a webinar. Webinar has a negative connotation to it that I'm going to be sold something and that I'm not going to be able to communicate and ask questions and that I'm not going to be able to see who else is on this call. Now, if you are trying to hide other investors because you don't want the sponsor and you're a co-sponsor or any of that stuff, the whole thing to me is it's not transparent. And I understand the ability to have access to your investors and not giving other people access to your investors, but I guarantee you that you're not the only person that an investor is investing with unless it's the first time they've ever been introduced to multifamily. And if they like it, you're not going to be the only one they invest with. Okay. Now, if you do the things I've described, you potentially could be. But trying to hide them from everybody else just shows that you're not transparent. Now, I'll leave it up to you what you do. I'm not telling you to open the world up and be fully transparent if you're uncomfortable doing that. I'm just telling you how I would do it if it were me still doing syndications and raising capital. I would have, like I do my master classes, everybody would be invited as a presenter. You have the ability to ask questions as we go. You can see everybody else in there. You can talk amongst each other. And for God's sakes, if somebody asks a hard question, don't kick them out of the frickin' meeting. What are you hiding? You do that, nobody on that call is going to invest with you. Okay. If you've got an opportunity that's good and you believe in it, there shouldn't be anything to hide. All right. So it's just my feelings. You guys do it the way you want to do it, but that's how I do it. So you can use this in presenting, whether it's a webinar, whether you do it masterclass style, however, or a meeting. I'd rather use a meeting than a webinar, but that's me. Again, I'm not telling you have to do it that way. Again, background you could fix. Okay. So the summary. So now we're talking about the deal itself. What's the name of the property? Its address, an image. Now, this is not the image of that property. The Point at Bailey Cove was an actual deal in Huntsville. One of our members asked me to go tour it because I was in Huntsville at the time. And so I went and toured it for her. This is not an image of the Bailey. This is actually an image of an apartment community that I sold a group that's doing very, very well today. This was their second or third apartment investment. I think this was their second apartment investment that I sold them. Okay, it was 23 units. So you just give a little description and some bullet points about the property. Highlights. Okay, now I put a bunch of different, and obviously this isn't aesthetically pleasing. What I wanted to do was I wanted to put in different tables that you could use and different balloons and styles and things like that. The key is that you get the information that needs to be displayed. How you display it is up to you. So through the offering summary template, I have all these different ways that you can display this stuff so that you can just copy and paste if you want to use that type of display, right? So purchase price, estimated raise, price per unit, current rent, pro forma rent, if that's what you're doing and buy it on pro forma. But you know me, I'm going to tell you, you should never buy on pro forma. But you can put what the market rent is if you so desire. And I don't have a problem with that. Okay. What the return percentages are and distributions, depending on what your business plan is, expected investor returns, number of units, purchase price, again, just different ways to display this stuff, okay? Here's more ways to display highlights: minimum investment, investment term, projected annual cash-on-cash return, projected IRR. Notice it doesn't say average annual return. It says cash-on-cash return. Your annual return should never be higher than the IRR. That should be, as soon as you see that, you should be questioning the data. Next is the property itself. So information about the property. Okay, its unit mix. Some pictures of the property. And again, just putting placeholders in here. Then the market. All right, you want to be detailed about the market. You all have access to Module 4 of the Strategic Partnering Workshop, which talks about how to do an economic base analysis, what to look for in a market. Okay, get that information into your summary. So first, you want to talk about the location itself. You can get this from the county or the city's website. You may also be able to get it from the Chamber of Commerce about the location. All the major employers, the demographics, okay? When I was pulling reports from Site to Do Business for you guys, I could still pull Site to Do Business reports. I just can't pull CoStar reports anymore. CoStar has put a stop to that. utilize those reports to your advantage. The area demographics, okay, median monthly rent, median house value, median household income. This one right here is a big one because it helps determine affordability. Economic highlights: job growth, unemployment rate, average income growth, total population, home ownership. This lets us know what the inverse is of who's renting. Rebecca asks, what report has CoStar stopped allowing to be pulled? Well, CoStar hasn't stopped it for everybody, just me. I got in trouble because of my YouTube channel. And so they have prevented me from exporting anything out of CoStar now. So I can't provide CoStar reports anymore. Is what it is. It is what it is. I did it to myself. It is what it is. So anyway, moving on. Come on, get down to the next one. All right, let's just go to the next one. There we go. So again, this was the snapshot. Now I could do this because this isn't an actual, I can still see everything in CoStar. I just can't export anything out. But this is just an image of the infographic that CoStar puts out for the market. And so I can take an image and send an image. That ain't a big deal. This is the tapestry. So from Site to Do Business, the psychographic information about the market. And this is just one of the top 3. If you wanted to put all 3 in there, you would end up with 12 slides. You really just want to put the top one in there. And the one you really want to focus on is the 3rd page, because it talks about renter versus home ownership, typical housing type, and then their housing information, their market profile. The one above it talks about their income and net worth, race and ethnicity, average household budget, occupation by earnings. Okay. And then the map just shows where the largest concentration of that specific psychographic is in the country. This was Huntsville. So Huntsville is that big dark spot right just before you get to the Tennessee state line. Oh, that one up there. Then we get into the plan. So what's our business plan? Okay. Interior upgrades. And well, so you can take these. I'm just throwing icons up here, just through a bar, some information here. So here's where you can do your interior upgrades, your exterior upgrades, maybe some landscaping stuff, maybe some operational efficiencies, things like that. What is your plan? And that just shows the ability to use icons and make it a nice, presentable infographic. Here's another way to do it. We got below market rents. One of the buildings had a post fire. We got tired interiors. What's the plan? So here's the problem. Here's the solution. Okay, financials, your CapEx budget. So we're going to do this to these number of units at this cost per unit for a total cost and when it plans to be completed. Same thing for the exterior. Okay, then the financials. Here are the rent comps. Okay, and you can say where the rent comps came from if you want to. Here's our capital stack. Here's our equity. Here's our bridge debt. Here's our permanent debt. Here's our investment term, our exit strategy. And then, of course, you want to show our average rent at purchase, at exit, and any notes, what our NOI is at purchase, our NOI projected at exit, notes, price per door, cap rate, etc. And here's another example. Now we're doing a stress test. So sponsors have stress tested the number of deals to determine cash flow in worst case scenarios. So our parameters here, as is, rent shock and vacancy shock. So we got break even occupancy and put that information in here, as is operation, then with rent shock and vacancy shock. Okay. Projected returns. Here is that information. Please tell me, ooh, I did put it in here. Get it out. You don't want it. Just take it out. And then the team. So obviously it's just a bunch about me because it's just a fictitious, but who you are. Okay. And then who the key principal or co-sponsor is, or primary sponsor if you're not the primary sponsor. And then the team themselves. Okay. And this is a great opportunity to highlight your operating partner. But if there are 3 teams that are, 3 co-sponsors, one of them's the operating partner, you can highlight them all. If this is a market or this is a blind opportunity, so you're just getting investors interested in you and your opportunities that you're looking for, then this will only be about your specific team. If this is property specific, then it should be about all the teams involved on the sponsor, including the operating partner. Okay. Here is the organizational chart. And then your final page, thank you for attending, how they can contact you, and then a Q&A session. All right. Now, again, these at the time, I've since changed my colors and my branding, but at the time, these colors were based on my colors for my branding. And I just wanted to put something together that you guys had that you can modify and make your own. All right. So again, you have one for property specific, one for blind, and one for just the market. Okay. Any questions on the offering summary? The supplement video will show you how to edit and modify that summary for PowerPoint. I don't even know what Mac's version's called. So I would assume it's not much different, but I don't know. So if you're using a Mac, my apologies. But, not so much because you're using a Mac. Sorry, I like being flippant about that. All right.
Yeah, but I have a Mac, but I use Microsoft. So I use PowerPoint, Word, all that. So you can do that on a Mac.
Ah, see, I didn't even know that. That's how little I know about Mac, how little I want to know about Mac.
Yeah.
Homework. Determine your offering strategy, position yourself as someone to invest with, answer all the questions, and create content around those questions. We didn't talk about that. But once you answer all those questions, you just got a whole lot of ideas for content. So when I talked about answering these questions before you even get the investor in front of you, if they've been following you a little bit, creating content around those questions will help you be able to answer those questions. Watch the video on modifying the offering summary template, and then modify the offering summaries to be your own. Go ahead and get them ready. Put them in your own branding colors with your branding, everything else. You don't have to really change anything else unless you know what market you're going after, then do one for your markets. If you know what your strategy is, do one for the blind. But until you get a property specific one, just modify it for your branding and your colors initially. Find potential investors and gain soft commitments so you are ready for the pending recession.